Hey traders! Welcome back to our YouTube channel. Today, we're exploring the Fibonacci retracement tool within Smart Money Concepts. This tool, used by institutional traders, helps pinpoint key market levels. In this video, I'll teach you how to integrate Fibonacci retracements into your smart money trading strategy, covering everything from plotting levels to advanced trading techniques. By the end, you'll enhance your trading and increase profitability. So, get comfortable, and let's dive in. From the knowledge we've always shared on this channel, I'm sure most of you have realized how crucial it is to buy at a discount price in an uptrend and sell at a premium price in a downtrend. But you might be wondering, are there specific levels within the discount price that can help us narrow down our buy zone range? Based on our trading experience and research, the answer is yes. We do have specific levels within the discount price that further narrow down our buy range, and those levels are 61.8% and 78.6%. At the 61.8% level, we set or execute buy orders, and below the 78.6% level is where you should always place your stop loss. Now, before we continue, let me show you how to configure your Fibonacci retracement tool on TradingView. Initially, your Fibonacci tool will look like this. Click on the settings icon, which will take you to the configuration menu. Untick all the other levels and leave only 0, 0.5, 0.618, 0.786, and 1. Once you're done, click OK, and this is what your new Fibonacci tool will look like. It's exactly what you need for the strategy I'm about to show you. Let's start from the basics of this strategy and then delve deeper into the advanced levels. First, to apply this strategy, identify your swing low and swing high. Drag your Fibonacci retracement tool from your swing low to your swing high. Now that you have all the levels in place, wait for the price to drop and interact with the 61.8% level. Place your buy order here, set your stop loss below the 78.6% level, and target above your swing high. Most likely, the price will play out and reach your target. Once the price breaks above our swing high, these points become our new swing points. Again, wait for the price to retrace back to the 61.8% level. From there, execute your buy orders with a stop loss below the 78.6% level and target above the previous swing high. Once more, the price is expected to push up and reach your target. These are the basics on which our strategy is based. It seems simple, but there's more to it than you might think. First, let's look at some price chart examples. In this chart, we see a change in market character signaling the start of an uptrend, meaning we should start looking for buying opportunities. To apply our strategy, first identify the swing low and swing high. Then, drag your Fibonacci retracement tool from the swing low to the swing high. We can see that the price pulled back to retest our 61.8% level. Place buy orders at this level, with a stop loss below the 78.6% level, and set your target above the swing high. After some waiting, the price pushed up and reached our target. Price broke above our current swing high, indicating strong buying momentum. For another trading opportunity, identify the new swing low and swing high. Drag your Fibonacci retracement tool from the swing low to the swing high, and then wait for the market to pull back and retest the 61.8% level. From there, execute your buy orders with a stop loss below the 78.6% level and set your target above the swing high. After some waiting, the price pushed up and reached our targets once again. This demonstrates how simple yet effective this strategy is when correctly applied. Now, let's jump to another example. In this second example, we had a change in market character signaling the start of an uptrend. We then applied our strategy to this first setup by identifying our swing points and inserting the Fibonacci tool. Unfortunately, in this case, the price missed our 61.8% level, and we missed our entry. It's important to understand that missing entries is part of trading. You have to stay disciplined and remain loyal to your trading plan, never force trades. When the price broke above the previous swing high, it indicated that buyers are still in control. We then identified our new swing points and inserted the Fibonacci tool. From here, we waited for the price to pull back and retest the 61.8% level. At this point, we executed our buy orders with a stop loss below the 78.6% level and set our take profit above the swing high. After some waiting, the price will most likely push up and reach our target. Before we move on to more complex examples, let's look at one last basic example. In this example, we will look at NAS 100 to demonstrate that this strategy applies to every trading instrument when applied correctly. Firstly, we noticed a change in market character indicating the start of an uptrend, meaning we should start looking for buying opportunities. We then identified our swing points and inserted our Fibonacci levels. As the price pulled back and retested the 61.8% level, we placed our buy order at this level with a stop loss below the 78.6% level and set our take profit above the swing high. Then, we wait for the price to play out. Price will most likely push upwards and reach our target. Price broke above our swing high, indicating that buyers are still in control. We then identify our new swing points and insert our Fibonacci levels. Next, we wait for price to pull back and retest the 61.8% level. At this level, place your buy orders with a stop loss below the 78.6% level and set your take profit above the swing high. Price will most likely respect this setup by pushing up and reaching our take profit target. With these 3 examples, I hope I've been able to demonstrate how this simple yet effective strategy can significantly revolutionize your trading game if applied correctly. By applied correctly, I mean you need to understand market structure. Market structure helps you know when to look for short-term and long-term buying and selling opportunities in the market. So now, let's look at market structure and see how you should trade this strategy in line with your current market structure. When analyzing the charts, always start with a higher time frame. On this time frame, identify your directional bias and key zones for long-term buying or selling opportunities. Then, transition to a lower time frame. On this lower time frame, look for short-term buying and selling opportunities. Additionally, use this lower time frame to confirm a setup you identified on the higher time frame. Let's look at this example to show you how to apply these concepts in your analysis. Let's assume this is the higher time frame. First, identify the directional bias, which in this case is bullish, meaning we will be looking for long-term buying opportunities. Next, identify key zones for possible buying opportunities. To identify our zones, we will use our Fibonacci levels. From this higher time frame perspective, we can conclude that price is most likely to pull back and retest the 61.8% level, giving us the opportunity to execute our long-term buy orders. Instead of waiting for price to pull back and retest this level, we can transition to a lower time frame to look for short-term selling opportunities during this retracement. However, it's important to note that once price interacts with the 50% level, we stop looking for short-term selling opportunities. Below the 50% level is considered a discount zone, where more buyers are looking for long-term buying opportunities. Continuing to look for selling opportunities in this zone means going against the buying pressure coming into the market. Always keep that in mind. Now, let's transition to a lower time frame to start looking for short-term selling opportunities. On this lower time frame, we had a change in market character signaling the start of the retracement, meaning we can start looking for short-term selling opportunities. Insert your Fibonacci levels and wait for price to pull back and retest the 61.8% level. Place your sell orders at this level with your stop loss above the 78.6% level and set your take profit below the local swing low, and price will most likely push down and hit your target. Since price missed the 50% level by a few inches, we can continue looking for further short-term selling opportunities. We had a break below our previous internal swing low. Once again, insert your Fibonacci levels and wait for the market to pull back and retest the 61.8% level. Execute your short-term sell order with a stop loss above the 78.6% level and set your take profit below the internal swing low. Once again, price will most likely respect your setup. Now that price has finally touched the 50% level, we stop looking for short-term sells and prepare ourselves for long-term buy orders. Price has finally retested our 61.8% level. From here, execute your long-term buy orders with a stop loss below the 78.6% level and set your take profit above the higher timeframe swing high and wait for the market to play out. This is just a demonstration to show you the importance of understanding market structure as a trader. It is a crucial tool that will help you make more informed decisions and improve your trading portfolio. Now, let's look at a price chart example where we further unpack this essential concept. In this example, we will use the 4-hour time frame as our higher time frame. We observed a change in market character indicating the start of an uptrend. This means that the directional bias of this market is bullish, and we should start looking for long-term buying opportunities. Next, we need to identify key higher time frame zones for potential buying opportunities. To do this, insert your Fibonacci levels. From this higher time frame perspective, it is clear that price is most likely to retrace back to retest the 61.8% level, giving us the opportunity to enter our buy positions. Let's transition to the lower time frame to see if we can catch short-term selling opportunities during this retracement phase. But remember, once price interacts with the 50% level, we stop looking for short-term selling opportunities and start anticipating long-term buying opportunities. Transitioning to the lower time frame, note that these levels are the Fibonacci levels from the higher time frame. I also made them larger so they do not interfere with the Fibonacci levels from the lower time frame. We observed a change in market character signaling the start of the retracement, indicating that we can start looking for short-term selling opportunities. Insert your lower time frame Fibonacci levels and wait for price to retrace back to the 61.8% level. From here, place your sell orders with a stop loss above the 78.6% level and set your take profit below the internal swing low. Price will most likely push down and reach your target. We had a break below this internal swing low, indicating that sellers are still in control. Once again, insert your Fibonacci levels and wait for price to pull back and retest the 61.8% level. From here, execute your sell orders with a stop loss above the 78.6% level and set your take profit below the internal swing low. Once again, price pushed down and hit our target. Note that since price tapped the 50% level of the higher time frame Fibonacci level, this indicates that we should stop looking for selling opportunities and start anticipating long-term buying opportunities. Additionally, price retested our 61.8% level from the higher time frame. Let's transition back to the higher time frame for a clear overall market perspective. Execute your long-term buy order at this level with a stop loss below the 78.6% level and set your take profit above the major swing high. After waiting, price pushed up and hit our target. If you're still with me, I hope you can see how valuable this strategy is when correctly applied. I challenge you to backtest this strategy on up to 50 setups. This way, you will learn how to use it effectively and be able to make adjustments to make it even more effective. We know that for every good strategy, there's always a downside. For this strategy, the disadvantages are as follows. First, you will experience higher risk per trade when trading on higher time frames. In this example, you can see how far away your stop loss is from your entry point. However, it's important to note that this only occurs on higher time frames. For the same setup on a lower time frame, you would risk less per trade. Secondly, you will experience a minimal win rate due to the fact that we did not add any confluences to our setups. Remember, adding one or two extra confluences can significantly increase your win rate. To address this issue, we will introduce a very crucial concept to our setup: lower time frame confirmation. This confluence will ensure that we risk less per trade while significantly increasing our win rate. Let me show you how. From this higher time frame perspective, we can see that price has pulled back to retest our 61.8% level. Instead of executing our trades on this time frame, we shift to a lower time frame to see if we can get the same setup. This minimizes risk and increases our chances of a successful trade. On the lower time frame, wait for price to break above this internal swing high. This signals that buyers are stepping into the market, making it safe to execute our buy orders. Insert your lower time frame Fibonacci levels. Before we continue, we can see that the higher time frame Fibonacci levels interfere with the lower time frame levels, so I will remove the higher time frame levels to provide a clear market perspective. After inserting your levels, wait for the market to pull back and retest the 61.8% level. From here, execute your buy orders with a stop loss below the 78.6% level and set your take profit above the major swing high. Price will most likely push up and hit your target. So we can see that by introducing lower time frame confirmation, we managed to lower our risk per trade. Our stop loss is now significantly reduced compared to executing on the higher time frame. Secondly, we managed to increase our chances of a successful trade by using the lower time frame confirmation as our confluence. Therefore, we now have an excellent trading strategy. Let's look at some price chart examples. On this higher time frame, we can see that price pulled back to retest the 61.8% level. However, executing your buy orders at this time frame is not favorable due to the higher capital at risk per trade. To have better risk management and a higher chance of a successful trade, let's transition to the lower time frame to look for better buying opportunities. On this lower time frame, wait for price to break above this internal swing high. This indicates that buyers are now stepping into the market, making it safer to start looking for buying opportunities. Insert your Fibonacci levels and wait for price to pull back and retest the 61.8% level. From here, execute your buy orders with a stop loss below the 78.6% level and set your take profit above the major swing high. Most likely, Price will push up and hit your target. If you made it this far, I hope you realize the crucial step of using lower timeframe confirmation before executing your trades. Remember, you only use this extra confirmation if your setup is on the higher timeframe. Take your time and practice this strategy, but remember, to effectively apply this strategy, you need to understand market structure and multi-timeframe analysis. We will delve even deeper into those concepts in our future videos. If you found this video insightful, hit that like button and subscribe. See you in the next video.